Thanks for joining us on Power Lunch. This is Bloomberg Quint and I'm Ira Dugal. Let's get straight to the headlines. The Sensex and the Nifty trade flat after a positive start. Global Qs limited in a holiday-shortened week. Shares of Reliance Communication surged close to 10%. The company is due to make an announcement at 2:30 p.m. Gas Authority of India Limited trading higher as well after IOC and BPCL express interest to take over the government stake in the company. The gas utility may want to merge with ONGC instead. And Vijay Rupani and his cabinet take oath in Gandhinagar today. All right, news coming in a holiday shortened and a quiet week, but there's still enough to talk about, starting with the markets. Neeraj is joining us as always. Neeraj, you had some action, if you can call it that, in the early part of the session.
Yeah, it's died down completely though. So for the Nifty 50 at least, or actually for all the key indices, there is hardly any action, and which is why today in a market check, there features not a single large cap name because well, the markets are flat. The top gainer or the top loser are up about 1% or down about 1%. So there is hardly any movement in a large cap space, but as is always the case with such a large broader market, there's a fair bit of activity. Now, as Ira said in the headlines as well, Reliance Communication stands out. It's amongst the principal gainers on the Nifty 500 as well, up about 14% currently, 18.5, and what a rally it's had since it hits the 10 rupee mark and then has seen a bit of a bounce back. Today we'll get to know at about 2:30 as to what is it that they are speaking about their asset sales and what it does to the overall console picture for RCom. So this is one key stock in news. There are a couple of others that I thought stood out for me. Firstly, this whole pack in aviation, the likes of Jet Airways and some of the others which are trading at new highs, and Jet Airways in particular. So never mind what's happening to crude or otherwise, but Jet Airways continues to rise and shine. So another 6% high at 802. It's trading close to life highs, so good going for Jet Airways in the session today. There was some strength that we saw in stocks like Cummins India as well, about 7.5% I saw Ashok Leyland looking fairly strong. That one was about 3%, so good moves there for those stocks. And then at the small cap end, gains are fairly strong. So Forbes and Company, which was at 3,200 a few days ago, is currently at about 4,700. FDC is up about 30% in trade. Jamna Auto and Auto Ank Company is up about 10% as well. So the gains are strong with fairly decent volumes as well. Not to discount a Welspun Corp, which won that order and is up about 8-9% as well. So good strong gains with fairly decent volumes at the broader end of the spectrum. Well, we might be in for a surprise. We expected a volume truncated week, Ira, but expiry plus the activity in the broader end of the spectrum may just bring the volumes and a little bit of volatility back into the markets.
All right, but otherwise at the headline, a quietish session. There could be individual stories playing out. Neeraj mentioned Reliance Communication. Let's focus a little bit on that. So if you pull up the stock, the stock's trading about 14% higher, but it's not just today that you have seen an upside in Reliance Communication. The stock's been buzzing for the last week or so on the expectation that Reliance Communications is going to do whatever it takes to stay out of insolvency. We will get into the details of what has transpired on Reliance Communications so far, but I just want to give you the highlights of what Mint newspaper had reported on Friday. They were suggesting that Reliance Jio has emerged as the top bidder for at least 3 of the asset packages that are on sale from Reliance Communications. These include the tower assets, the optic fiber assets, and the spectrum assets. This is news that was reported by Mint newspaper on Friday. Bloomberg Quint could not independently confirm that. But the story so far on Reliance Communication has been a convoluted one. It actually started, many months back. But if you start from the point of where this strategic debt restructuring plan had been invoked. Bring up those graphics and you'll see it was back in June that you had lenders invoke the strategic debt restructuring plan. Remember, as part of that plan, they convert some part of the debt into a majority equity holding. In this case, about 7,000 odd crore of debt was being converted into a majority equity holding under the plan. Along with that, the company detailed a plan to raise about 33,000 crore through asset monetization. The total debt of the company stood at about 45,000 crore at that point in June. Now, what happened after June is where the twists and turns begin. Now, the conversion price that had been agreed upon in June stood at about 24.71 rupees per share. But the stock plunged well below that price. In fact, in November, it plunged very briefly below the double-digit mark, below the 10 rupees per share mark. At this point, lenders have started to get nervous about the conversion because if they convert at below the price, they take a hit immediately in terms of mark-to-market. If they don't don't convert, then it was near certain that RCom would go into insolvency. RCom did present a new asset monetization plan in October as well. As part of that plan, again, they talked about 33,000 crore that they intended to raise through asset sales, including monetization of some of their real estate assets. The company that is, termed this as a zero write-off plan. But the problems for RCom continued to add up because RCom also defaulted on its dollar bonds. Now, RCom said that as part of their agreement with the domestic lenders, the standstill agreement that comes into play under the strategic debt restructuring scheme, they are not required to pay out any of their outstandings. So they defaulted on their dollar bonds. Nevertheless, whatever the explanation, it was the first dollar default bond by an Indian company in about 15 months. So got a lot of attention globally as well. And SC Lowy, which is a well-known bond and loan trading firm, said that RCom faces real risk of insolvency. The real risk of insolvency has started to pile up over the last couple of months. There are now at least 3 petitions pending, one from a large financial creditor, which is China Development Bank, also from operational creditors like Ericsson and Manipar Technologies. A public relation firm, ironically, has also filed an insolvency petition against RCom. So it seems that they would be trying to fend off all of these insolvency petitions as they come up with a plan today. And if what has been reported in newspapers is correct, then perhaps Reliance Jio, the brothers company, would have some part to play in the rescue of Reliance Communication, although one assumes on entirely commercial terms. All right, that's one big story. 2:30 is when the news come in. Let's move on to other news that's coming in today. 2 state-run oil marketing companies are keen to buy out the government stake in Gas Authority of India Limited. The gas utility has other plans, though. GAIL has written to the oil ministry arguing that it makes more sense for them to merge with ONGC. All of this is according to news agency Press Trust of India. So how could the different scenarios play out for GAIL? Yatin Mota is standing by with more details and analysis, actually, on what could work best for the company. Yatin.
Well, if you look at it from the GAIL standpoint, clearly we have the ministry already announcing that there will be integration of oil and gas companies in the coming financial year. Of course, we already have the process for HPCL and ONGC kicking off, but GAIL is something wherein we have the news report suggesting that both IOC and BPCL independently have written to the oil ministry regarding the acquisition of government's stake in Gas Authority. Now, the GAIL's government holding is worth close to 46,700 crores, and probably this could be a windfall for the government of India. And also, oil marketing companies like IOC and BPCL do believe that that makes strategic sense for them because they will now get into the gas distribution business along with the fuel marketing that they do on a regular basis. However, on the contrary, we have GAIL, which has written to the ministry stating that the better fit for GAIL on a strategic standpoint could be ONGC because it's a gas producing company, whereas GAIL is a gas distribution company. So it makes sense for them to integrate with ONGC. But it is very difficult at this point in time to say whether or not ONGC's balance sheet would support the GAIL's acquisition because they are already in talks with HPCL for buying out the government stake. So a very tricky position. But if you look at GAIL, the shares are up nearly 60% on a one-year basis. On the strong, robust performance on the financial front, and also if you look at it from the valuation perspective, probably one of the expensive stocks in the oil and gas space with FI 18 price to earning ratio being close to 26 times. So not really very cheap, but it will be very interesting to see as to how the entire divestment procedure for GAIL really pans out when it comes to the other oil marketing companies like BPCL and IOC.
Yatin, thanks so much for that. The stock trading about 1% or so higher. Staying with the resources space, ONGC Videsh will buy oil wells rather than drilling for new reserves to meet its production targets. In an interview with Bloomberg News, ONGC Videsh's managing director Narendra Kumar Verma said that short-term production goals can only be achieved through producing targets. What does that mean? Saket Sundria of Bloomberg News joins us. Saket, thanks for coming in. So what was the message that you took away from the interview?
See, ONGC Videsh has a very daunting target. They need to meet 20 million ton annual production target by 2020, just 3 years on the run. And the company produced around less than 13 million tons in FY17. So they are well short of the target, and any exploration asset will take more than 5 years at least. So they need to do something more immediate and drastic. The aim is clear. Now they have to go for assets which are already producing both oil and gas. So this target of 20 million ton includes both oil and gas. And that's why they are now on the lookout for gas assets which can immediately lead to an add-up of production that can help them achieve the target.
A couple of questions, Saket. So first one being that what is the status of their existing, say the Russian fields, etc.? They have not been performing as per par, is it?
Yeah, exactly. Like they had some deals in the past, some exploration assets as well as producing, but they're not, performing as they would have expected them to. Like for example, Imperial Energy, that's way below their expected targets. Same is happening with Sudan and Venezuela. Venezuela is into trouble of its own, so the company is not getting the expected mileage that it was supposed to get. So all these put together, as well as the exploration assets which it had bought like 5-6 years ago, which should have added up into production by now, they're still languishing way behind. So all this have added to the company's problems. It's still way short of its target of this FY18. They're supposed to do about 14 billion tons, and entirely because of the Russian acquisition they did in FY17. The Rosneft, Vankorneft acquisition that they did, 26% stake added up to more than 50% of their current production now. Okay. So there's something similar the company wants to do in the next 3 years, which could give up them like a big boost to their volumes.
And they have the balance sheet strength even now?
Yeah, the parent is debt-free, and ONGC Videsh is entirely on debt, but their existing assets are giving them good returns. So they can, funding I don't think will be a problem because the company has sovereign backing. They're perceived as good as the sovereign. So
they can borrow cheaply, relatively cheaply, domestically.
They always manage to. Yeah. No, they generally, ONGC Videsh would go for a overseas borrowing because they have a dollar-linked balance sheet and they mostly perform outside India. Yep. So probably that's not going to be a big deal for them.
All right. Saket, thanks so much. That's the focus for ONGC Videsh as they try and meet their targets, looking at perhaps more producing assets. The Modi government has set an ambitious target of 10,000 kilometers for FY18, that's in the road sector, but the pace of construction and new orders have slowed down considerably. The reason? Land acquisition hurdles continue to haunt this sector. Purva Chitnis standing by with more details. Purva, can you tell us what's going on there? What is stalling the implementation of these projects and how they intend to overcome some of these issues?
The pace of the road construction project in the country has slowed down, and it is evident from the number of road kilometers the NHAI has awarded so far. The overall target for NHAI was to award 10,000 kilometers in this financial year, which is below the 15,000 kilometer award target which the NHAI had last year. And the analysts that we spoke to believe that the main reason for this is the land acquisition hurdle. According to the law, it is mandated that up to 90% of the land is first to be acquired, and only then the construction work can begin. So this is why the projects are getting delayed. And one such project in Maharashtra is the Mumbai-Nagpur Expressway. So far what we know is only 40% of the land is acquired, and the work on the project can begin only by April or May next year. So this is eventually going to push the project deadline by 2 to 3 years.
All right, it's ironic that this slowdown in implementation is there at a time when investors are extremely bullish about the road construction companies, assuming that order flows will pick up, but implementation not quite keeping pace. Let's move on. 2017 was largely a washout year for electronic retailers who had to grapple with demonetization and GST hurdles. The only saving grace was high-end television segment as consumers continue to shift towards better picture and sound quality. Charlene D'Souza standing by with a snapshot of the year gone by, Charlene, for electronic retailers. What did it look like?
Indians are definitely buying. In the last year, bought bigger and better televisions that showed pictures which were up to 4 times sharper. This has helped consumer durable retailers to make up for lost demand due to demonetization and GST. Along with smartphones, Vijay Sales and Chroma said that 4K and OLED flat panel TVs have been the outliers in an otherwise washout year. Smartphone sales drove volume for retailers, which which was driven by Chinese manufacturers selling handsets in the world's second largest market through brick and mortar stores after launching exclusively online, according to Ritesh Ghoshal, Chief Marketing Officer of Croma. TVs drove Croma's value growth by 15%, while volumes rose by 6% due to smartphones, which roared on models like OnePlus 5T, Samsung Note 8, Xiaomi Redmi series, Vivo V7 and 7 Plus. Now, Vijay Sales attributed the falling prices of high-end panels for growing demand. However, he also said that even a single-digit growth is not bad today. Appliance makers like Godrej and Whirlpool both said that they witnessed a slowdown this year due to demonetization and GST, and said that Godrej and Boy said that the growth rate has slowed down to 11 to 12% from 15% in the previous year. Samsung India said that consumers are migrating to larger screens even in smaller towns, and that has been a big trend for them. Now, their rival LG Electronics also said that its flat panels business did well this year.
All right, Charlene, thanks so much for that. That's one segment in the broader consumer play. But what does the environment look like for the broader retailers, and what do they hope to do in the year ahead? We spoke to the management of Shoppers Stop. Let's hear them out.
We opened more than 4 stores during the year. Another 2 stores are coming up between December and March. And going ahead, every year we are still targeting to open about 5 stores a year, which have been signed on for the next 3 years' time. So today we are at 81. We should close the year at about 83, and then with the addition of about 15 stores over a 3-year period, we should be nearing 100 stores very clearly. We are also adding on in our beauty format, the Estee Lauder, MAC, Clinique, Bobbi Brown, Smashbox portfolio, about 10 stores a year, and that number again should cross 100.
Sir, you've also introduced a lot of new private labels. Could you tell us what is going to be the contribution of those new labels to your revenues in the near future?
Currently, we have a contribution of about 15% coming out of our private brands and exclusive brands. The way we are targeting to grow the portfolio is not by adding of new brands, but by really getting traction into the existing brands themselves, which is Top, Life, Kashish, Hot Curry, Vittorio Frattini, and Frattini Woman, and Elisa Donatien. Those are the key brands that we have in the apparel side. We do have other brands also, the home side, but the main driver would be apparel. And the way we are targeting is over the next 2 years, take the share to about 22% over the next 24 months period, from the current 15 to go to 22. We are doing a lot of work there in terms of pricing, assortment, fashionability, presentation in the store as well, and branding, which will really drive this growth.
Right, so what is your expectation of same-store sales growth as we move into the new year?
So we have always been targeting at least 8% like-to-like growth, and we believe Q4 we should be able to achieve that, and similar or higher number in the next 2 financial years, because we believe all the impacts of demonetization, GST are getting over by the end of Q3. So 2018 should be a great new beginning, and that should continue well if the economy continues to grow the way it is growing right now.
Sir, could you tell us where have your plans with Amazon reached? Because there was an announcement this year where Amazon acquired 5% equity in Shoppers Stop. Could you give us any updates on that front?
This tie-up actually operates on 3 levels. One is our catalog getting uploaded on Amazon.in, number 1. We already started uploading the catalog, but by Jan end the catalog will be fully operational and will also be like an anchor store on Amazon's fashion page. Number 2, a lot of activations are planned in next year between our First Citizen membership program, their Prime membership program, and joint marketing programs that would also be rolled out. And plan 3, again in the next year, sometime around the second half, would be creating experience centers, Amazon experience centers within Shoppers Stop.
The world's second largest tea company, Tata Global Beverages, has been restructuring its strategy for more than a year now, which includes a thrust on premium and higher margin products that flavored water and new tea blends. Its MD and CEO Ajoy Mishra believes that the customers are shifting to more premium products, and that's what the company is trying to play as one of its key strategies. Listen in.
Premiumization and a high focus on innovation are also pillars of our strategy that is pretty much playing off. So almost every new NPD that we are launching is steadily premiumizing our portfolio. So that is pretty much a key pillar of the strategy.
All right, shifting focus from the consumer space to the IT segment, 2017 hasn't been a great year for these companies. Stocks are seeing some traction now, though, after Accenture reported a strong set of numbers. Does this indicate a pickup in client spending? Do Indian technology giants stand to gain as well? CP Gurnani of Tech Mahindra spoke to us. Listen in.
20th of January, President Trump was sworn in. There was a fair amount of, I would say is anxiety or a concern with many of the global economies about the shape and the direction that the US economy will take, or more important is, will the protectionism change the way the businesses are conducted globally? If the US economy continues to do well, I do believe that the global economy can start looking at approximately 3.5% growth. It is not the Trump factor which is changing our business. It's actually the technology which is changing our business. As long as we can balance the changing requirements of our markets, I think we will be in good shape. We have anticipated the change. We are more digital than others. And if we are more digital, if we are more automated, if we are able to create service offerings which are near the customer, and when you talk about 343, you're talking about 3 global trends in the market, 4 differentiated service offerings, and how they benefit the customers. The 3 of the end is about customers running faster, customers being able to change faster, and the customers being able to grow faster. So as long as we remember that our customer is changing, and if we can help our customer change, I think we are in good shape.
All right, that's the IT industry. It is the last week of 2017 and there's a lot of looking back, so forgive us for that. But we are at Bloomberg Quint getting you a sense of what the year looked like and stocks in particular that have clocked stellar returns this year. Our special series of multi-baggers of 2017 today focuses on Venky's India. Yatin Mota is standing by with what worked in the company's favor. Yatin.
Well, if you look at Venky's India, that stock delivered a return of nearly 7 times. And clearly that is one multi-bagger we will be focusing on, and starting with the key metric or the return ratios, how really it's shaped up. If you look at the return on assets, return on equity and return on capital, probably we have seen a very strong improvement in the entire financial year 17, and in fact the return on equity for the company is now close to 26.3%. If you look at the FY19 price to earnings ratio, that is close to 22 times, probably something like a premium FMCG company in terms of demand of valuation that usually we see. Coming to the next slide, and if you look at the overall performance for the company on the balance sheet front, really the debt, which was probably at a peak level in FY15, has gradually come down to level of 300 crores. So not only the return ratio and the profitability of the company improved, but also we have seen substantial improvement for the debt levels for Venky's India. Now, if you look at the key revenue metric, how really the company does in terms of revenue composition, we have nearly 50% of their revenues coming in from the poultry and poultry product business, and the remainder, roughly 53% comes in from the animal health as well as the oilseed segment. So equally big, if you could say, the animal health business of the company. And if you look at the margins also for the animal health business, that is really the one which is driving the overall profitability. Margins for the company stood at 20% for this particular segment. Of course, poultry business and the oilseed segment continue to deliver stable set of margins for the company. Of course, if you look at the financials and look at how the growth really has shaped up for the company, they have done a profit after tax of nearly 80 crores for the first half of this financial year, which was almost equivalent to the FY17 profitability. So significant improvement coming in the first 6 months of this financial year for Venky's, and probably that explains really how and why the share prices have moved up for the company, and significant amount of margin improvement, nearly 200 basis points coming in for Venky's as far as the first half of this financial year's performance is concerned. Of course, this chart really shows you how the egg prices have really moved. Probably that is a benchmark as to how really the revenues of the company are expected to grow. So from a level of 338 rupees, for 100 eggs, it has moved close to 400 rupees now, stable from the peak of close to 500 rupees because of the seasonality factor. And finally, we have what's really working for the company. What are the key risks? Of course, sharp rising poultry prices, better realizations, satisfactory demand-supply situation, especially after the beef ban that we saw, is something which is working in favor of the company. Also, high utilization is something that has seen improvement for the company. Raw material prices also have declined steadily for a company like Venky's, and that explains you the reason why the margins really expanded for the company. And finally, we will talk about the risks, and that is the final slide. Events-based risks like bird flu and decline in the chicken and egg prices is something that would see some pressure moving forward. And these are the key risks that the company is exposed to. But overall, on a net basis, as I was mentioning earlier, 7 times is what the share price of Venky's moved for this calendar year 2017.
All right, Yatin, thanks so much for that. That's the multi-bagger series continuing here on Bloomberg Quint. Step into a quick break, come back on the other side. Vijay Rupani and his cabinet have taken oath. We will get you the details. Welcome back. You're watching Power Lunch. Let's take a look at the headlines at the half hour. Markets off, new highs hit this morning. The Sensex trade flat after hitting 34,000 level in morning trade. Nifty 2 trading modestly in the red. Mid caps outperform. Shares of Reliance Communication gain for the 4th time in 5 sessions. The company due to make an announcement today at 2:30 p.m. Gas Authority of India Limited also trading higher after IOC and BPCL expressed interest to take over the governance stake in the company. The gas utility wants to merge with ONGC though. All right, we'll get to the markets and some of those other stories in a minute. Just flagging off political developments, Vijay Rupani has taken oath as Gujarat's Chief Minister for the 2nd time today. Rupani and his entire cabinet, including Nitin Patel, who stays Deputy Chief Minister, was sworn in Gandhinagar amid much fanfare. Whole host of leaders from the BJP, including Prime Minister himself, Party President Amit Shah, and all the Chief Ministers of the NDA-ruled states attended the ceremony. This is the 6th straight win for the BJP in the assembly elections. The opposition, of course, taking heart from the fact that the BJP's total seat count missed the 100-seat mark. All right, that trigger, of course, well built into the markets when the announcements and the results came. But let's take a look at how markets are faring today. Pradeep joining us with the key movers, but also the index lost steam after a positive start in the morning, Pradeep.
Yeah, actually, even SGX was not really hinting at a great day. But if you speak to the dealers, there is not much participation from institutions. Global players are still in holiday mood, and that is likely to continue for the entire week. But in that case, focus shifts to the expiry this week, and looks like the way option traders are positioned, it won't be easy for Nifty to cross 10,500 and close above that. So maybe for this week, traders are preparing for a range of 100 points between 10,400, 10,500, and stock-specific moves will continue, however, and there are quite a few stories even today. If you look at metal stocks, they are doing well. The frontliners like Steel Authority, or look at the smaller ones like Godavari Power, because steel companies have managed to hike prices yet again, and that kind of shows the confidence and the kind of traction that these companies are getting in domestic market. You also have some high beta names like DLF moving up. Then there was the stock of Cummins and Kirloskar, a deal due to which both these stocks have moved up. So there is strong news flow. You also have news flow for ADAG. So all the ADAG stocks continue to move up. We are waiting for that important announcement the company is going to make later today. Also, there are some reports of JP Associates that the company will probably, that the bankers will probably restructure the loan by the end of this week. So there is excitement there also. So there is stock-specific trades that continue. In fact, small cap index, when I checked it last, was up almost 0.75%. But index is kind of stuck in a range, and it looks very difficult that we'll see a decisive move in Nifty before expiring.
Interesting that steel prices and steel stocks are in focus. I think news suggesting that all the large steel companies have been able to raise prices. So from a commodity standpoint, to the extent that you're looking at steel, good move.
Definitely, and interestingly, this morning the cues were negative because in Chinese markets, steel prices, the iron ore prices had corrected. Now, if you look at the steel companies, it's yet another positive for the steel processing companies in that case. And then the news of price hike came in. Last week also we had spotted, the smaller names like Godavari Power, Prakash, and all these ore and alloy companies were actually doing well in Indian markets. So that run continues, and also Steel Authority and the large cap stocks have also joined in. So metal remains a story that we have been tracking for 2 weeks now. There's a strong, bottoming even in commodity markets and in equity.
Interesting. Thanks, Pradeep. See whether that story actually plays through into 2018 as well. Sunil Singhali of Reliance Capital is optimistic on a broader economic or at least earnings revival going into 2018. He, however, does not expect stellar returns like what we saw this year. Most are saying that you could still see upside, but not the kind of upside that you saw in 2017. Hear out a slice of that conversation on our special series, Thank God It's Friday.
We are quite optimistic. Frankly, we have been optimistic right from 16, but we have gone wrong.
Right.
I think we are reaching a situation where things are now falling in place. So 2016 end to 2017 end, we had a lot of headwinds.
Right.
Headwinds were from obviously appreciating rupee. We had demon. We had GST.
Right.
I think all those are becoming tailwinds now. So we have a stable rupee. We have the effects of demon almost gone.
Right.
We have companies and sectors coming out of GST. And if other countries in the world who have implemented GST are a reflection, then maybe it will become a tailwind rather than a headwind. We also have the support of commodities generally doing well. So, commodity stocks should report some decent earnings. Corporate banks, which were providing a lot and therefore subduing the earnings overall, should not be doing that going forward, and there can be surprises as far as earnings are concerned.
Right.
And I think even from an export front, exports suffered in 2017 for India. We are seeing a revival, and there's also a push from the government to encourage exports. So maybe some of the export sectors might, contribute towards rising earnings.
Right.
So our base case view is that FY19 we should see 16 to 18% growth as far as earnings are concerned.
All right.
Nifty 50 and Nifty 500. I've just chosen that because it's a slightly broader index. They've returned close to 30 and 36, 37% so far in 2017. And you also spoke about how the underlying factors are improving as far as 2018 is concerned. So just want to understand if you believe some of these indices could give similar or better returns next year. I know it's a very short-term call when it comes to mutual fund investment.
So, yes, 2017 has been a great year for Indian equities. In fact, not only for Indian equities, for global equities, So wherever you go, whether it's US, which has given 25%, or Hong Kong, which has given more than 30%, I think across markets, you have seen very, very decent returns. As I said, volatility has been low. 2018 is not going to be as great. We'll have more volatility. We are coming out with high expectations and high base effect. Our view would be that Indian equity markets can give you double-digit returns, but to expect the returns which we got in 2017 would be something keeping your expectations too high. So I think we have to keep our expectations moderate. If we get higher returns, well and good, but we do expect mid-teen kind of returns to be the base case as far as 18 is concerned.
Based on your outlook on the markets then, we'd like to know what are the risks that these markets are not factoring in right now? It could be domestic or global.
So as I mentioned, 2017 was a fairly stable year, low volatility globally. 2018, definitely there will be more volatility. There is no doubt about it. So I think we have to be prepared about it. Also, global markets have all moved up in sync. There is always a possibility some event happens in the world, and that would also impact India. We have to be prepared about it. And I think now in India, you can't have a scenario where corporate profitability doesn't move up. So if you have a couple of more quarters where corporate profitability disappoints, then these valuations cannot sustain. So I think these are some things which you have to take in mind. And the other thing is that once the election gets nearer, we have seen in the past that markets will get a little cautious, a little jittery, and we will see that towards the end of 2018 also.
All right, shifting focus to the bond markets, not looking like they're in the brightest of moods as we come to the close of this year. The 10-year yield, pulled that up and it was trending towards 7.29 when I last checked. Let's pull up that yield chart. It's moved up once again after Friday where it moved up, then it corrected, and now it looks like it's moving up. I believe a lot of people in the markets are watching out for the GST collection numbers for November, which are due later today. Let me just get a voice in on the bond markets. R. Sivakumar, Head of Fixed Income at Axis Mutual Fund, is joining me on the phone line. Good afternoon, sir. Thanks for taking our call. What's going on, sir? Why is the bond market in such a grumpy mood? I mean, I know they're expecting fiscal slippage, but at 727 levels, more than 100 basis points spread over repo, all that should be factored in, no?
I would argue yes, that much of the negatives would have got factored in, except for certainty about the size of the slippage. I think, really speaking, that's what we're waiting for. If you see the two things that our markets have been worried about over the last few weeks and months, the number one risk, I think, has been from fiscal slippage. And the second is the risk that RBI will be a lot more hawkish going forward, which in turn, of course, could be influenced by the fiscal itself.
Is there, some sort of a sensor on what could be the incremental borrowing or what could be the size slippage that the market would have already factored in, sir?
I would imagine about at least, a 30,000 crore figure would not be much of a surprise for the market in terms of slippage for the current year. But I would also say that the markets have not just been worried from slippage for the current year, because there has been talk from government about possibility of revisiting the FRBM targets over the next few years. What that would suggest is that it's not just a slippage for the current year that we should be concerned about, but potentially a much longer term or a medium term slippage in the fiscal deficit, which would add to supply over the next 2 to 3 years.
I see. So the concern is that they may not move closer to that 3% mark even when the next budget gets announced, sir?
I would say that is the second big risk from a fiscal perspective, and we must remember that the RBI will be watching the fiscal announcements very carefully. A significant slippage in the fiscal, especially over the next few years, could lead the RBI to be a lot more hawkish going forward. So these things do feed off each other. And on the other hand, of course, if the government does meet its fiscal numbers, then they can lob the ball back to RBI and say, we are going to meet our fiscal numbers and it's time the RBI steps up to ease policy. So this fiscal does swing both ways. If you have a large slippage, then of course there's a risk that you could see yields go higher. But on the other hand, if the government surprises us with a more positive number, all eyes will turn to RBI and we'll suddenly expect RBI to actually take a more softer tone.
What is your sense? I guess once these announcements come through, you'd have a clearer idea. But where do you think yields should settle? Because, a month or so back, people were saying 710, yields won't take out 710. Now you're almost 730.
I don't think there is any specific level. But having said that, now I believe that much of the risks have been priced in. That does not to say that we should see yields softening from here. There's a very big difference from saying that much of the worst is over to saying that it's good times ahead of us. I would say that as long as the risks persist, both in terms of fiscal policy as well as risk to inflation, which also seems likely biased on the upside, we may not see any immediate drop in yields, but we might be at a situation where yields are very close to peaking out.
Sir, interestingly, now the currency markets are not showing any sort of nervousness. Neither are the equity markets on this fiscal side. I guess we'll know in retrospect whether the bond market was correct or the currency and the equity markets were correct and the bond markets were getting nervous unnecessarily.
This deviation is not just unique to India. I mean, we've seen, for example, bond yields in U.S. Remain low, even though U.S. equity markets have done really well. So it does appear that there is some kind of divergence in expectations across asset classes, whether that's in India or in global markets. I don't have any clear explanation for this, and I would imagine that in a few weeks' time, when we get the budget, this argument will get resolved one way or the other.
Mr. Sivakkumar, is there a little bit of, say, also, very local factors playing into the bond markets in the sense that banks unwinding some of the excess SLR that they were sitting on? I ask that because FIs, while small positive, but FIs flows into debt in December have still remained positive.
Yeah, well, the FI flows are dependent on the limits, and their limits are almost full. So, you're only getting some incremental buying as and when those limits are getting used up as we get very close to filling it up. So we are really dependent on domestic demand, and as you rightly pointed out, banks are sitting on significant excess SLR. In the bank recap plan, for example, again, banks are going to have a large amount of government securities on their balance sheet going forward. So there is shall we say, a large overhang of supply today and in the foreseeable future. So all of this is definitely weighing on the market, certainly in terms of sentiment, because who is, after all, going to hold much of the securities? We must also remember that another constituency, which is the typical buyer of government securities, which is insurance, PFs, etc., have readily available state development loans which are available at a good spread over the central securities. So to the extent of their sovereign allocations, a lot of money can easily go into SDLs, which are in effect crowding out the center.
No, fair point. Mr. Sivakkumar, last question. In terms of the global aspects of, what is impacting our bond markets, is there also, some amount of expectation that, global yields will move up, have been moving up, and that is also getting priced into our yield levels, sir?
In a very short-term sense, that is true. That is to say that when you have a large up move in global bond yields, especially the U.S., you do see a sort of a sympathetic response from India. But I would say that when you look at it over a period of time, over periods of weeks and months instead of days, that impact was much reduced. So we are not really looking at being a sustained impact. What we will see having a sustained impact is things like oil prices. And you have seen, for example, over the course of the last few months that when oil has consistently stayed, let's say, at 60 or higher, you have seen pressure on India yields. So we are looking at global signals, but not directly from bond yields, but rather through commodity channels.
All right, got that, Mr. Sivakkumar. Thank you so much for taking our call, explaining what the bond markets are looking like. So while the equity markets are entirely quiet, bond markets not so much. As we said, we should get the GST collection numbers for the month of November post 5 p.m. at least, or sometime in the second half of the day. Once you get that number, you'd probably be able to get a final fix on what kind of slippage. The government, through sources, have suggested that they will take a final call on borrowings after the November number. So the November number becomes all the more important from a bond market perspective. But that global trigger that we were talking about is going to be important in terms of at least sentiment and direction for bond yields, also equity markets. What do central banks do in 2018 is the big question to watch out for. As we look back at the year that has gone by and the year that comes up, we're focusing over the next few days on what global central bank policy is going to look like. So we'll start with the US Federal Reserve. In the case of the US Federal Reserve, I think the general trend is going to be normalization starting to pick up pace. If you look at the dot plot, which is put out by the FOMC, that is suggesting that there would be 3 rate hikes from here on. So you'll go from about 1/2 on the Fed funds rate to about 2.25. The market seems to be pricing in about 2. Some have suggested that there could be as many as 4 rate hikes. But if you go with 3 rate hikes, you would probably see the Fed fund rate move towards 2.25 as you go through 2018. If you look at the expectations, for years ahead, so you are saying, at least these are Bloomberg expectations, which see the Fed funds rate moving to about 2.1% median estimate by 2018. 2.7 by 2019, and 2020 you could see the rate above 3%. This of course all assumes that there is no accident on the growth front. On the inflation front, remember, central banks have continued to hike rates, or at least the Fed has continued to hike rates even though inflation has not met its target of 2%. So far they have been discounting that slight underperformance of inflation. Whether that changes and whether they slow down their pace of rate hikes, we'll know closer to 2018. But at this point, these are the expectations on the Fed funds rate. More focus will be there on what the Fed does in terms of its balance sheet reduction. Now the roll-off, basically them not reinvesting some of what they get from the proceeds of their current bond holdings. That process started in 2017. It will gain pace in 2018, and that huge balance sheet of 4.7 trillion will slowly start to first peter out in terms of growth and then come off. The expectation is that you would see another 10 billion getting added in January. So starting January, the pace of the balance sheet roll-off becomes 20 billion from 10 billion currently. Now every quarter, 10 billion keeps getting added. So by the time you hit 2018 end, you will see the quantum of assets being rolled off hitting 50 billion. So I think that's what a lot of market participants have focused on, that the process that just started in 2017 will gain pace in 2018 and hence could impact liquidity conditions and possibly fund flows. What comes together with this is the fact that ECB is also starting to pull back, although very, very slowly. In the European Central Bank's case, there will continue to be purchases of bonds into 2018, but the pace of those purchases will halve from 60 billion euros to 30 billion euros in January. They will continue at least until September 18 and perhaps beyond. The ECB chief, in the commentary that has accompanied these announcements, has been fairly dovish, so nothing has rattled the markets, and he said they expect to continue reinvesting proceeds for an extended period of time. He also said that the benchmark interest rate is expected to remain unchanged at 0%. The Bank of Japan, slightly different kettle of fish, because there, of course, you know that inflation is less than half of what the targeted level of 2% is. But you could still see the pace at which bond holdings are being increased come off in 2018. So according to a Bloomberg survey, the increase in bond holdings in 2018 could be at 44 trillion yen. That would be lower than the 61 trillion yen that the Bank of Japan has bought in 2017, that number until about November. Now remember, in Bank of Japan, the issue is not about the target of how much you purchase, but the target is the 10-year yield. And the Bank of Japan has so far maintained that they would like to see the 10-year yield near zero, and they're buying accordingly. But 1/3 of the respondents surveyed by Bloomberg in that survey suggested that over the course of 2018, you could see the Bank of Japan move its 10-year yield target a little bit higher above that 0% mark, which could then have implications of the proportion or the quantity of bonds that they're buying from the market in 2018. So you put it all together and you get a sense of why investors are very, very closely watching what is happening in the global scenario. We had spoken to Bharat Iyer of JP Morgan on Friday here on Bloomberg Quint, and he talked about the fact that the risks for India are more global in nature rather than local in nature. And one of the key risks he pointed out to was that normalization of policy and what it would mean for fund flows and also sentiment here in the markets. All right, let's move away from global markets and bring the conversation back home and into the insolvency process, which again gathered steam in a big way in 2017 and will continue into 2018. It looks like operational creditors, who are defined as vendors, suppliers, and employees under the Insolvency and Bankruptcy Code, have been at the forefront of initiating insolvency proceedings against companies. While it gives them much needed voice in the system, the legal fraternity is divided over the efficacy of such a move, especially since the threshold amount has been set as low as 1 lakh for any of these creditors to approach the National Company Law Tribunal. Shivani Saxena and Payaswini Upadhyay of Bloomberg Quint spoke to a whole host of legal experts to find out where they stand on this issue. Are operational creditors going too far, or is this a much needed adjustment in the system? This on Bloomberg Quint special show, The Fine Print. Hear out a bit of that conversation.
The inability of a company to pay its debts to financial and operational creditors triggers insolvency under the Insolvency and Bankruptcy Code. The IBC recognizes banks as financial creditors and vendors, suppliers, employees as operational creditors. By one estimate, nearly 3 out of every 5 cases filed under the IBC have been initiated by operational creditors. Compare this to the pre-IBC era, where experts point out operational creditors used to be victims of judicial delays and promoter apathy.
Operational creditors have always had a very difficult time when it came to recovery of money, especially in light of the vast delays in our judicial system. The usual methods of recovery would either be through filing of a civil suit or through initiation of arbitration. With respect to arbitration, although it is definitely faster, the arbitration clause needs to be present in the invoices and purchase orders, which wasn't the case with the smaller vendors and smaller suppliers. It wasn't unheard of to see bigger companies, sometimes even listed companies, refuse to pay the smaller vendors and refuse to pay some of their mid-level executives and employees their salaries for months together, because the alternative for the person recovering the money would be to start to file a suit, to pay the court fees on the suit, and then to go through the uphill legal process at least for a few years before any sort of decree can be obtained.
But the ability to initiate insolvency proceedings with a default threshold of 1 lakh rupees has empowered these operational creditors. Just 10 months into the new insolvency regime, 4 operational creditors of Reliance Communications moved to the tribunal against the company. Ericsson was the first to approach the NCLT for its unpaid dues of 1,150 crore rupees, followed closely by Tech Mahindra for non-payment of dues worth 8 crore rupees. Both these companies finally settled out of court. But just when RCOM thought it had managed to calm down its operational creditors, its public relation agency initiated insolvency proceedings for non-payment of mere 43 lakh rupees. These dues amount to a little more than 2.5% of RCOM's total debt of over 44,000 crore rupees. For Applied Electromagnetic, in a first, it was an employee who triggered the insolvency process for the company, failing to pay him 46 lakh rupees in salary. And it is not just vendors, suppliers and employees, but brand ambassadors too are using the insolvency process to claim their dues. Mahesh Bhupati and Lara Datta initiated the insolvency process against jewelry manufacturer Gitanjali Gems for not paying them their dues. Experts are divided as to the efficacy of the default threshold for initiating an insolvency proceeding.
So I think operational creditors, disgruntled employees, employee unions would naturally like to take the most efficacious remedy that is available to them. So long as the bankruptcy code allows that remedial mechanism to them, I think these people will take that remedy. I think the question that comes up is it in best interest of the IBC or the bankruptcy board, the company as a whole and the economy as a whole, to allow the bankruptcy code to be abused to such an extent that it really becomes the forum for adjudicating all the small operational disputes.
The operational creditors are using IBC to recover their dues from the companies by issuing demand notice for a small amount to such a large scale companies, and even a smaller amount of creditor like 1 lakh is the minimum cutoff. So if there is a default of 1 lakh, a creditor will put a company of say 1,000 crore of the size of a company into this process. Which creates issues, problems with the company as well the financial creditors themselves. So definitely there should be some restraint on this, which can be in the shape of making this default criteria a little proportionate, or maybe proportionate to the size of the company, maybe. So that like if it's a 1,000 crore company, at least a default of 1 crore should be there.
Several stakeholders have asked, and pondered whether the threshold of a default is too low for invocation of IBC proceedings. I think to my mind, though the threshold may appear low, I think it is a well thought out and kept that way, because if you keep the threshold as too low, the fallout of it may well be that a lot of small defaults can trigger the insolvency proceedings, which may be seen as a very drastic outcome, but in the medium term and long term, it is going to have a more positive impact in terms of improving the payment cycle and payment culture of the companies. Traditionally, operational creditors, including employees, never used to get paid small amounts, and they used to stand in queue and never get anything out of these legal proceedings. Or if the financial creditors were to do a restructuring, the operational creditors and employees never used to get any seat on the table. But with the IBC and with such a low threshold of default, I think the companies are going to take all payments more seriously. And I think over a period of time, we are going to see an improvement in the discipline and payment culture, and have a culture of treating your debts and dues properly. And I guess the law, all that the law is saying is that if you can't pay dues, then you don't have the right to be in business.
The IBC may have empowered operational creditors, but its extent is still debatable. The interest of the operational creditors is served if the debtors agree to settle, or better still, pay up. But their situation is worse off under the Insolvency Code compared to, for instance, a civil recovery suit if a resolution plan does get approved. In a resolution scenario, the operational creditors stand to recover a lot less, as seen in the Synergies Dure case, where the operational creditors recovered only 4.3% of the total amount owed to them. Given that the law does not allow for an out-of-court settlement without the intervention of the Supreme Court, this might be a more likely scenario that the operational creditors are looking at.
Whether it was the previous regime or this regime, under winding up or under IBC, it was always a mixed bag, or it was a roll of the dice for the operational creditors, because if a company is wound up, by the time a company is actually a stressed asset, it usually will not have enough money to cover its financial debts or towards its secured creditors, let alone its operational creditors and unsecured creditors. Similarly, under the IBC, regardless of what happens at the end of the 180-day or 270-day resolution period, the fact remains that the operational creditors are looking at very little money. For example, there have only been 2 revivals that have gone through the NCLT or gone through the IBC at the end of the month of September. But in either of them, the operational creditors were not getting much.
If you look at the abuse of the provisions, an insolvency or the provisions to liquidate the company were always seen as a last resort. And even under the earlier Companies Act, you could have initiated a claim for liquidating that company only when the court really believed that there is no other way but to liquidate the company to pay off the dues. And therefore, just like that, even the current bankruptcy code provides for a provision that says that if the claim is seen as malicious in nature, which is not to, or the intent of the claim is not to resolve for the insolvency, then the court can slap a penalty. Concept being the same, that use it as a last resort, use it in genuine cases. If at all the court sees that the claim is malicious in nature, and the test is always subjective. The NCLT will have to look at it on a case-by-case basis. But if at all the claim is seen as entirely malicious in nature, then a penalty can be slapped and has been slapped.
It is a popular view that the efficaciousness of the IBC is in its time-bound remedy. However, some experts feel that this very effective nature of the IBC itself is in jeopardy as more and more operational creditors crowd the NCLT with operational dues and recovery claims. However, on the other hand, some experts feel that this will lead to more compliant, more disciplined company and fewer IBC processes.
All right, that's the story of operational creditors under the IBC playing out. That's all the time we have on Power Lunch today. Thanks so much for watching. Good afternoon.